There is a story behind the Southwest Airlines strategy. Why being cheap is a competitive moat that most people have never heard. This is Capital Logic, and today we are telling it. Before we dive in, if you find value here, hit like and subscribe so you never miss an episode. Let's begin. While other airlines struggle with profitability, Southwest Airlines consistently turn a profit for decades by embracing a no-frills model, proving that being cheap could be the ultimate competitive advantage. But how did they pull this off in an industry known for razor-thin margins and intense competition? Stay until the end. I'll break down 3 lessons from Southwest Airlines Playbook you can apply to your business this week. If you want business breakdowns you can actually use, hit subscribe and the bell. To understand how Southwest Airlines turned being cheap into a competitive moat, you have to go back to the very beginning, 1971. This wasn't just another airline launching. It was a direct challenge to the established order, a maverick move in an industry dominated by hub-and-spoke giants. While others were focused on gourmet meals and multiple cabin classes, Southwest had a radical idea: offer low-cost, no-frills flights, initially just within Texas. They connected Dallas, Houston, and San Antonio, not with luxury, but with affordability and frequency. It was a simple proposition, but profoundly disruptive. But this wasn't some smooth ascent to market dominance. Just 1 year into its operations, in 1972, Southwest faced a crisis that would define its future. The airline was on the brink of bankruptcy, with a mere $143 in its checking account. Think about that, an entire airline nearly grounded by a triple-digit balance. To survive, they made a desperate, yet brilliant, move. They sold one of their 4 aircraft. Now, imagine the pressure. How do you maintain your flight schedule with 25% fewer planes? This wasn't just a financial decision. It was an operational ultimatum. This forced Southwest to innovate, to squeeze every possible ounce of efficiency out of its remaining fleet. And that's where the legend of the 10-minute turnaround was born. Employees were challenged to get a plane unloaded, cleaned, refueled, and reloaded with new passengers in just 10 minutes. At the time, this was unheard of. Competitors took an hour or more. But Southwest pulled it off. This wasn't just about speed, it was about survival. It meant their 3 planes could do the work of 4, or even more, allowing them to maintain their schedule and generate revenue with a significantly smaller asset base. The most impossible feat wasn't just a temporary fix. It became the genesis of their entire operational philosophy, a relentless pursuit of efficiency. That near-death experience in 1972 forged an operational blueprint that turned constraints into staggering advantages. Southwest understood that true competitive advantage wasn't about offering more, it was about doing less, better, and cheaper. Their most famous, and perhaps most counterintuitive, strategy was the single aircraft type, only Boeing 737s. Think about the ripple effects of this decision. Maintenance crews only need to be trained on 1 airframe. Spare parts inventory is dramatically simplified, reducing storage costs and ensuring higher availability. Pilot training is streamlined, as every pilot is qualified to fly every plane in the fleet. This isn't just a cost-saving measure. It's a non-obvious competitive moat that significantly reduces complexity and operational friction. Southwest is, in fact, the world's largest operator of the Boeing 737 next-generation family, operating 803 aircraft as of December 2025. This scale likely gives them significant bargaining power with Boeing, securing better deals on aircraft purchases and parts. Then there's their route system. While legacy carriers relied on the hub-and-spoke model, funneling all flights through major hubs, Southwest pioneered point-to-point travel. This means direct flights between cities, bypassing congested hubs. What does this achieve? Fewer delays caused by a single point of failure. Often, more direct routes for passengers. And for Southwest, it translates into fewer lost bags and reduced labor costs compared to the complex logistics of a hub-and-spoke system. But the real magic, the core of their efficiency, still comes back to those rapid turnarounds. Even today, decades after the legendary 10-minute sprint, Southwest's average turnaround time remains significantly shorter than the industry average. In September 2023, it was 49 minutes, the shortest among major U.S. carriers, and they have plans to reduce it even further to 44 minutes. This isn't just a minor improvement, it's a fundamental difference in asset utilization. This rapid turnaround strategy has historically saved Southwest the equivalent of 35 aircraft. Imagine the capital expenditure that represents 35 fewer planes they need to buy, maintain, and staff, all because they can get their existing fleet back in the air faster. It's a testament to how meticulously they optimized every single step of their ground operations. These aren't just isolated tactics. They are interconnected elements of a cohesive strategy. The single aircraft type feeds into faster maintenance and turnarounds. The point-to-point system reduces complexity and delays, and the rapid turnarounds allow them to fly more routes with fewer planes, generating more revenue per asset. This relentless focus on operational excellence, turning seemingly mundane elements like aircraft maintenance and ground time into strategic advantages, set the stage for something truly remarkable: consistent profitability. Southwest Airlines was profitable for 47 consecutive fiscal years, from 1973 through 2019. That is a streak virtually unheard of in the notoriously volatile airline industry. But how did they sustain this, especially as the industry evolved and competitors tried to imitate them? What other hidden levers did they pull to cement their low-cost dominance and create a brand that resonated with millions? But Southwest's brilliance wasn't just about making every flight a masterclass in efficiency. It was also about shrewd financial engineering, a hidden layer of defense that insulated them from the industry's notorious volatility. You see, airlines are incredibly susceptible to fuel price swings, which can decimate profits overnight. While competitors were scrambling, Southwest had a secret weapon: fuel hedging. Between 1999 and 2008, a period marked by significant energy market fluctuations, Southwest saved over $4 billion through this strategy. Think about that for a moment. $4 billion. This wasn't just a clever accounting trick. It was a strategic fortification that allowed them to maintain their competitive fares even when oil prices soared, giving them an almost unfair advantage. While other airlines were hiking prices or cutting routes, Southwest could continue to offer its low-cost promise, further cementing its position in the market. This financial foresight was just another facet of their counterintuitive approach. They weren't just cheap, they were sustainably cheap, building a financial moat around their operational one. Now, you might think that a company so focused on cost and efficiency would struggle to build customer loyalty. After all, isn't flying often a frustrating experience, especially on a budget airline? But here's where Southwest truly defied expectations. They understood that cheap didn't have to mean nasty. In fact, they cultivated a fierce customer connection, turning perceived downsides into unique selling propositions. Their approach, which they dubbed transparency, was revolutionary. While other airlines nickel and dime passengers for every conceivable extra, from seat assignments to carry-on bags, Southwest offered a refreshingly simple proposition. 2 free checked bags, for example, were a standard offering for decades, a policy that was only changed recently, in May 2025. And perhaps even more critically, they famously had no change fees. Think about the psychological impact of that. In an industry notorious for punitive charges, Southwest offered flexibility and peace of mind. You could book with confidence, knowing that if your plans shifted, you wouldn't be penalized with exorbitant fees. This wasn't just about saving money, it was about respect for the customer. This commitment to a straightforward, customer-friendly experience paid dividends in loyalty. How do we know? Look at their Net Promoter Score, or NPS. This metric measures customer willingness to recommend a company's products or services. Southwest's NPS of 48 significantly outshines the airline industry average of 33. That's not just a marginal difference, it's a chasm. It shows that people aren't just tolerating Southwest because it's cheap, they genuinely live flying Southwest. They feel valued. They appreciate the consistency, the lack of hidden fees, and the often friendly demeanor of the staff, which, as we discussed, stems directly from Herb Kelleher's employee-first philosophy. Even their seemingly quirky policies like the absence of assigned seating, a policy that also changed on January 27, 2026, played a role. While chaotic, it simplified boarding, reduced costs, and, for many, added a sense of egalitarianism and speed. Everyone was in the same boat, literally. Their frequent flyer program, initially the Company Club in 1987, rewarding trips flown, and later Rapid Rewards, evolving to a revenue-based system in 2011, further cemented this loyalty by making it easy and transparent to earn and redeem points. Of course, no business journey is without its headwinds, and Southwest, despite its formidable moat, has faced its share of turbulence. The airline industry is inherently susceptible to external shocks, from economic downturns to global pandemics and even aircraft manufacturing issues. Perhaps one of the most significant recent challenges was the grounding of the Boeing 737 MAX aircraft. As the world's largest operator of the 737 next-generation family, and aiming to be an all 737 MAX operator by 2031, Southwest's reliance on a single aircraft type, while a massive strength for efficiency, also became a vulnerability. When the 737 MAX was grounded globally in 2019 following two tragic accidents, it hit Southwest hard. The impact on their operating income for the full year 2019 was an estimated $828 million. That's nearly $1 billion wiped out due to circumstances largely beyond their control. This forced them to cancel thousands of flights and significantly scale back their growth plans. Then came the unprecedented shock of the COVID-19 pandemic in 2020. The entire travel industry ground to a halt. Southwest's annual revenue plummeted by a staggering 59.66% to $9.05 billion from $22.43 billion in 2019. For a company that had been profitable for 47 consecutive fiscal years, from 1973 through 2019, this was an existential threat. Yet, Southwest's underlying resilience, built on its deep operational efficiencies and strong customer base, allowed it to navigate these storms. As travel began to recover, so did Southwest. Its annual revenue rebounded by 74.51% in 2021 to $15.79 billion, demonstrating a strong recovery post-pandemic. And the growth has continued. In 2023, Southwest reported record full-year operating revenues of $26.1 billion, a 9.6% increase year-over-year. Even more recently, in July 2026, Southwest reported its highest-ever quarterly revenue at $8.4 billion, a 16.4% increase from 2025. This isn't just recovery, it's robust growth, proving that their fundamental strategy remains incredibly potent. Southwest's journey is a masterclass in turning perceived limitations into strategic advantages. They didn't just survive, they thrived by being consistently, meticulously, and strategically cheap. But what can you take away from this story? What are the universal principles that allowed Southwest to build such an enduring, profitable business by embracing a strategy that everyone else dismissed? Now here are 3 lessons from Southwest Airlines' Playbook you can apply to your own business. Lesson 1. Simplify operations. Standardize your core tools and processes to reduce costs and increase efficiency, creating a unique competitive edge. Southwest proved that a streamlined fleet and direct routes can translate directly into lower fares and higher profits. They understood that complexity often hides in efficiency. Lesson 2. Empower employees, delight customers. Invest in your team's well-being and autonomy, knowing that happy employees deliver exceptional customer service. Southwest's legendary culture isn't just a feel-good story. It's a strategic asset that keeps customers coming back, even when facing delays or disruptions. They understood that your people are your greatest differentiator. Lesson 3. Innovate constantly, adapt to change. Regularly question your business model and adapt to evolving market demands and customer expectations to maintain relevance. From their early days challenging established carriers to their continuous focus on efficiency, Southwest has always been willing to rethink how they do business. They understood that standing still is the fastest way to fall behind. If you want more business breakdowns you can actually use, subscribe. I'll see you in the next one. The Southwest Airlines strategy, why being cheap is a competitive moat, is one example of a pattern that repeats across the most successful businesses in history. Once you see it, you cannot unsee it. Subscribe to Capital Logic, and we will keep showing you how the game is really played. See you next time.